Governor Das, we are indeed grateful to you, deeply grateful to you for agreeing to be here with us today, despite your super busy schedule in meeting the unprecedented challenge the entire ecosystem is facing. COVID 19, as the governor himself has said on many occasions, is the worst health and economic crisis in the last 100 years, with unprecedented negative consequences for output, jobs, and well being. The pandemic perhaps represents so far the biggest test of robustness and resilience of the world's economic and financial system. In the midst of all this, Mr. Das's presence at the RBI has been reassuring, to say the least. And his calm disposition is just one of the many reasons for that. The entire team at RBI, under his stewardship, deserves compliments for the speed of response in a constantly changing world where the traditional ways of governing and rulemaking have become completely irrelevant. Mr. Das's formidable track record as an able administrator in the government, a great communicator, and someone who listens to all stakeholders carefully is a refreshing change from many others who are obsessed with living in splendid isolation. These wonderful qualities have endeared him to everybody. But despite the stress his job entails, Mr. Das has kept his terrific sense of humor intact. And I'll give you one example. When a newspaper article wondered whether his heart is still in the government, Mr. Das told reporters the next day, I don't know, and I quote, I don't know where is the heart and where is the mind. All that I know is that both of them are with me. By his own admission, Mr. Das is an eternal optimist. We all hope it remains that way. So, ladies and gentlemen, the stage is set for what you have been keenly waiting for, a keynote address by Governor Shaktikanta Das. Let me add, today's discussions are being moderated by my colleague Tamal Bandyopadhyay, consulting editor of Business Standard, who, as you all know, is perhaps the best in the business. I would now request the governor to deliver his keynote address. Thank you very much. Governor Das, please.
Thank you, Syamalji, for that introduction. Good morning and namaskar to all the participants. It's good to see so many participants and good to see so many MDs and CEOs of banks who are participating in this conclave. And I would like to thank at the outset Business Standard for inviting me to be here. And I have been watching very carefully the proceedings, not live, but subsequently. I have been keeping track of the proceedings of this conclave, of this event which you have arranged over the last fortnight or so. So my congratulations to Business Standard. And when Tamal spoke to me and invited me, obviously it was not possible for me to say no. And Shyamalji, you will agree that, and you will remember that I had earlier agreed to participate in a similar event, but because of the interruption of the pandemic, that event could not take place. And but anyway, I'm extremely happy to be here. And since today's session is devoted to banking, I would confine my address primarily to the area of banking. The COVID-19 pandemic still continues to keep the world on the edge. The pandemic has so far infected more than 2-3 crore people and has claimed more than 8 lakh lives worldwide. The world is struggling to find a vaccine or a cure to the deadly virus. In India also, the spread of pandemic continues unabated, though the fatality rate is much lower. As the pandemic ravages on, the economic impact is hard to measure. While there are green shoots and some businesses are getting back to pre-pandemic levels, the uncertainty over the length and intensity of the pandemic and its impact on the economy continue to cause concern. In the wake of the pandemic, RBI has stepped forward and has so far announced various liquidity, monetary, regulatory, and supervisory measures in the form of interest rate cuts, higher durable liquidity, moratorium on debt servicing, asset classification, standstill, and very recently a special resolution window within our prudential framework for resolution of stressed assets. The framework for resolution of COVID-related stressed assets is a well thought out decision taken in consultation with various stakeholders and is aimed at striking a balance between protecting the interest of depositors and maintaining financial stability on the one hand, and preserving economic value of viable businesses by providing durable relief to businesses as well as individuals affected by COVID pandemic on the other hand. We expect efficient and diligent implementation of the resolution plans by the banks, keeping the above objectives in mind. While the moratorium on loans was a temporary solution in the context of the lockdown, the resolution framework is expected to give a durable relief to borrowers facing COVID-related stress. RBI's response to the situation arising out of COVID has been unprecedented. The measures taken by RBI are intended to deal with the specific situation of COVID and cannot obviously be permanent. Post containment of COVID, I repeat, lest I am misunderstood. I repeat, post containment of COVID, a very careful trajectory needs to be followed for orderly unwinding of the various counter-cyclical measures taken by the RBI, and the financial sector should return to normal functioning without relying on regulatory relaxations and other measures as the new norm. Now, I would like to very clearly say it's not as if we are going to unwind all the measures which we have announced. All that I am trying to highlight is that we are very carefully monitoring the situation, and post containment, after the pandemic has been controlled and when we enter the pre-pandemic, post pandemic phase, then only there has to be a very calibrated, non-disruptive and cautious exit plan introduced. I am highlighting this point just to emphasize that RBI has taken or is taking a long-term view of things and not just thinking about tomorrow. We do think about today, we do think about tomorrow, we do think about day after, we also think about 1 year ahead or 2 years ahead, what next. So therefore, it's a comprehensive view that we are taking, and by no stretch it should be assumed that RBI is going to unwind any of the measures in the near future. In my address today, as I said, I would like to dwell upon the following theme. It is time for banks to look deeply within, and the focus will be on reorienting banking post-COVID. Just like boosting immunity of the population is the key to tackle the pandemic, the key to long-term financial stability would be to foster tangible improvement in the inherent ability of the banks to withstand exogenous shocks like the current pandemic. As I have stated elsewhere, the causes of weak banks can usually be traced to one or more of the following conditions: an inappropriate business model given the business environment, quality or lack of governance and decision making, misalignment of internal incentive structures with external stakeholder interests or shareholder interests, and similar other factors. Accordingly, the core of resilient banks is made up of good governance, effective risk management, and robust internal controls. And I am quite, I'm quite pleased to state that the overall, the Indian banking sector continues to be sound, continues to be stable. I'm highlighting these points because these are the areas which need greater attention. I'm highlighting these points not because they are absent or anything like that. I'm highlighting on these points because they need greater attention, and as everyone would agree, there is always a room for improvement. In recent years, the business landscape of banks has undergone significant change. Today, the banks need to look out for sunrise sectors while supporting those sectors which have the potential to bounce back. For instance, banks need to look at prospective business opportunities in the rural sector which remain unexplored despite efforts to support it. Banks also need to look at the area of startups, renewables, logistics, value chains, and other such potential areas. I have just listed a few, but there are several others. The banking sector has a responsible role to play, not only as a facilitator of growth of the economy, but also to earn its own bread. Thus, a complete relook at the business strategy and orientation is the need of the hour. Scale ignites the volume effect in business turnover, but that presupposes bigger size of banks. Despite several reforms in the banking sector since its nationalization, lot more can be done and needs to be done. With change in time, the nature of reforms needs to be reconfigured. The current steps towards consolidation of public sector banks in line with the Narasimham Committee recommendations is a step in the right direction. Indian banks this way can reap the benefits of scale and become partners in the newer business opportunities across the globe. Larger and more efficient banks, both in public and private sector, can compete shoulder to shoulder with global banks to get a decent space in the global value chain. Size is essential, but efficiency is even more important. Efficiency, however, is much broader concept and requires several other factors to evolve and act along its side. The prerequisite will be to use technology. The quality and ingenuity of technology should match our aspirations of acquiring scale and diversion of business across the globe. The focus of use of technology should shift from transactions based to business oriented. While introspecting on newer ideas to improve the health of banks and quality of banking, it is fundamental to reform the culture of governance and risk management. These two areas lend inherent strength to businesses of banking, and a good amount of work has already been done in this direction. As you are aware, recently we have uploaded governance, a document on a discussion paper on governance in commercial banks, and we have received large number of comments, and they are under examination, and we will take into consideration all the suggestions and comments which have been received and come out with a final document. While it is natural that capital providers or investors would like to remain alive to the aspects of how exactly a bank is run, it is worthwhile to allow sufficient leeway to the management of the bank and to the board of the bank to run the affairs of a bank in a professional and autonomous fashion. A decent distance between the owner and the professionally sound management and the board would promote robustness of banking institutions. And this is a point which has been spoken about earlier. So I think I thought let me just highlight and touch upon this area, but this is an area which is constantly under discussion. There will be newer risks with newer business models for banks, especially in the context of COVID and going forward. More so when the banks get bigger and more connected across diverse jurisdictions. High growth by virtue of newer business models can be achieved with clear understanding of one's own strengths and weaknesses. Remaining overly risk averse may seem to be a measure of self-immunization, but will be self-defeating as it would affect the bottom lines of the banks adversely. Risk propensity should be aligned with individual banks' measured risk appetite. The risk management system should be sophisticated enough to smell vulnerabilities brewing within the various businesses and well in advance, and should be dynamic enough to capture the looming risks in sync with changes in external environment. One visible area of concern in the arena of risk management is the inability or the ability to manage the incidence of frauds, both cyber-related and otherwise. The higher incidence of frauds which have come to light in the recent times have their origins in not so efficient risk management capacity of the concerned banks, both at the time of sanctioning of loans as well as in post-sanction credit monitoring. And there are considerable room for improvement in these areas. An effective early warning system and forward-looking stress testing framework should also be an integral part of risk management framework of the banks. Banks should be able to pick up incipient signals of stress faced by their borrowers and take proactive remedial action within the resolution framework established or set up by the RBI, announced by the RBI last year on 7th June. And this, the rearranging of the loans or the credit facilities which have been given to the borrowers when there are incipient signs of stress, if it is done in a timely manner, naturally it will contribute to preservation of asset value of the borrower. In addition to strong risk culture, banks also should have appropriate compliance culture. There should be robust assurance mechanism by way of internal audit function. This is an integral part of sound corporate governance. And the banks also should highlight on the quality of customer service and redress of customer grievances. I'm just touching upon these points without elaborating further. The written text of my address will be uploaded in the RBI website immediately after my address and this interactive session is over. So I'm therefore not reading out the entire text of my address. I'm just highlighting and touching upon some of the major points. Indian banking and financial system has indeed displayed tremendous operational resilience in the face of COVID and lockdowns. Going ahead, financial institutions, and sorry, before I move on, I must say, when I say that Indian banking has displayed tremendous operational resilience, I must mention and compliment the banks for having maintained operational continuity in such challenging times. And our deepest appreciation goes out to all employees and officers and staff of the banks who have been working day in and day out, manning the front offices. And many of them have lost, some of them, I would not say many, some of them have lost lives while working on the counters and in the front offices. So our deep appreciation goes out to the commitment of the officers and employees of the bank. And it is indeed a sign of the maturity of the Indian banking system that, and thanks to technology which they have adopted, that continuity of operations have been maintained throughout this entire pandemic period. And I'm sure going forward, it will be adhered to, not only in terms of doing the operations, day-to-day operations, but also in terms of, let us say, for example, dealing with the moratorium announcement by the Reserve Bank. And now one does expect, the resolution framework for COVID stressed assets, which we have announced. We have announced very defined and calibrated and, very defined and specified timelines. And I'm quite confident and I'm sure that the Indian banks, the Indian banking system, both public and private sector banks, will rise to the occasion and complete the entire process in time with due diligence. Going ahead, financial institutions in India have to walk a tightrope of nurturing the recovery within the overarching objective of preserving long-term stability of the financial system. The current pandemic-related shock is likely to place greater pressure on the balance sheets of banks, leading to erosion of their capital. And when I say this, I'm stating the obvious. It should not be read as if the government is sounding a warning signal or alarm signal. When we face a stressful and extremely stressful situation like this, which is once in a century, naturally it affects the balance sheet of banks. As I said earlier in the SBI conclave, to say that the banks going forward will face stress is stating the obvious. What is more important than saying this, something which is obvious? What is more important is how the banks proactively react and respond to this challenge, which is ahead of the Indian banking sector, which is ahead of the Indian financial sector. So what is more important is how we respond to the situation, and not that we are in the midst of a stressful situation. The current pandemic-related shock is likely to place greater pressure on the balance sheets of the bank, as I said, leading to some amount of erosion of capital. Proactive building of buffers and raising capital will be crucial not only to ensure credit flow, but also to build resilience in the financial system. And it includes resilience of individual banks and financial entities, as well as resilience of the financial sector as a whole. We have already advised, that is RBI has already advised the banks, and including the banks and also the large NBFCs as well as the deposit taking NBFCs, to assess impact of COVID-19 on their balance sheet, asset quality, liquidity, profitability, and capital adequacy. Based on the outcome of such stress testing, banks and NBFCs should work out possible mitigation measures, including capital planning, capital raising, and contingency liquidity planning, among others. Upfront capital infusion would also improve the sentiment of investors and other stakeholders alike for the sector to continue remaining attractive for investors, both domestic and foreign, over the medium to long term. Some of the banks have already either raised or announced capital raising. This process needs to be carried forward vigorously by banks and NBFCs, both in the public and private sector. In conclusion, I would like to say that COVID-19 poses several challenges for banks and the financial sector. Proactive action on various fronts, some of which I have attempted to highlight, will enable us to deal with these challenges effectively and maintain the soundness of Indian banking system. I am reminded here of a quote from Leo Tolstoy in War and Peace. I quote, "A battle is won by those who firmly resolve to win it." Thank you very much.
Thank you, Governor, and very warm welcome to this, we call it fireside chat, but on webinar, what do we say? There are many questions already for you, but probably we may not take for time's sake, because all the questions which I am going to ask you, a few questions are primarily because I don't understand banking much. So I have spoken to the market participant, economists, bond dealers, and so on and so forth. So I've collated all those. Only I have two personal questions, one in the beginning and one at the end. Sir, you have the toughest job being the country's chief money man at this point of time. We saw Dr. Jalan coming in late 90s in the midst of East Asian crisis. We saw Subbarao walking in just a week ahead of Lehman collapse. We saw 2013 governor was, when the India's current account deficit widened and rupee was sleeping. But this black swan event surpassed everything. So how does it feel, sir, managing, being the country's money manager at this point of time? Because no governor has quoted Mahatma Gandhi so many times.
Well, I think how does it feel is perhaps a question I should be replying, if at all, if and when I write my memoirs. But I must say that, our effort has been in RBI, and I must appreciate, the contribution of all my colleagues in RBI. We are, monitoring the situation, and we are very, very careful and watchful of the emerging developments in the domestic economy, in the global economy, in the financial sector, in the money market. And it's a challenge which we have to deal with. When you go out and play a game of cricket or football or any other game, you have no time to think how it feels. For example, in the game of cricket, if a ball comes, you have to just, you have split second to think about it and take a decision to hit the ball or deflect the ball or play a defensive stroke. So you have to take decisions in anticipation of certain situations. You need to take decisions which are proactive to deal with emerging situations. You also need to take decisions which respond to emerging challenges. So, as I have said earlier, it's never a dull moment in a central bank, and more so in times like this.
Thank you, Governor. It's a privilege and honor to have you among us. Not today, I'm talking about in Indian Central Bank. Sir, you have refrained from giving either estimate on GDP or inflation. And you are probably the only central banker globally. Only once at the height of COVID crisis, FOMC in US, they refrained, but they continued. And you always cite that there's uncertain time. But the feeling is this actually central bank is adding to uncertainty by not giving any estimate. Once you are convinced that you said that that inflation will be far lower in the second half, but you are not quantified. You also had said in the annual report that this time economic scenario is far worse than post Lehman, because at that time economy was growing and here economy was faltering when COVID hit. So what actually prevents you from giving the estimates? You are the only central bank globally.
No, you see, the times are very uncertain. In fact, I said it in another interview recently also. The times are uncertain and the situation keeps changing very fast. So if you give any number, whether it is with regard to inflation or with regard to growth, there is absolutely no certainty that 1 month down the road the figures will not be changed. I'm talking especially about growth, and growth is not something which is impacted by domestic factors or the domestic COVID curve. It is also impacted by global factors. It is also impacted by the COVID curve in other parts of the world and so many other global developments in matters of impact of COVID, or in matters of how the countries are responding to the COVID situation. So in an uncertain situation like this, when a central bank gives a number, the central bank has to give a number, the number in a very, very responsible manner. The central bank doesn't have the luxury of giving one number today and modifying it 1 or 2 months down the road. And as I have said a few days ago in another interview, once there is some amount of clarity about the COVID curve, or about the other aspects around COVID, then RBI will certainly start giving the numbers. And also, let me mention, you said that in the annual report we have pointed out that the growth was already under stress in India before the COVID. Yes, 2019, and precisely for that reason, the RBI had initiated a cycle of rate cuts as early as February 2019. It was mainly to respond to the, to the slowing momentum in our growth. So therefore, but I must mention that in certain other aspects, Indian economy and financial sector this time around was far more resilient than what was the situation during the global financial crisis. This time, our debt to GDP had improved. This time, our fiscal deficit was, very much back on rails. This time, inflation was also under control. This time, the current account deficit, which is very important for the financial sector, the current account deficit was also well under control. So therefore, it's not that Indian economy was fragile going into the pandemic. I think it's a mixed picture. In certain areas, the growth had slowed down in India going into the pandemic. But in certain other areas, I think Indian economy was far stronger and had many positive features vis-a-vis what was the situation during the, when the global financial crisis hit the Indian economy. But coming back to your main question, I think we will start giving the numbers once we have clarity. And we are constantly, engaged with several experts and outside, and internally also we are deliberating on this issue. We will start giving the numbers once there is some amount of clarity about the COVID situation.
Thank you, Governor. Very reassuring to hear you the strength of Indian economy and the banking system. Just for the record, no offense intended. Even on certain times, when the times are certain, RBI's estimate of, particularly of inflation, it's not exactly correct. I mean, it keeps on changing, but that's a separate story. Sir, you spoke about anticipating this and being proactive and cutting rates. Since February 2019, you have cut 250 basis points, and since February 2020, you have cut 115 basis points. But it seems that market is not listening to it. If you have seen the bond yield the past, since your last policy, where you were extremely dovish statement, but then you refrained from cut because of the inflation worry, or if I may say not worry but concern. So in retrospect, do you think that you front loaded the cuts little early? It could you have been little slower in cuts, because now probably you have exhausted at least that avenue. Am I correct in saying that?
No, first thing I would like to say is that we have not exhausted our policy options, whether it relates to the rate cut or it relates to any other aspect of central banking. We have not exhausted our instruments or ammunition. What we have said, what the MPC resolution said, and what I have said in my minutes, MPC minutes, and what the other members of MPC have also said, is that the decision of the MPC was to keep the gunpowder dry. And with regard to the two aspects of your question. The first question you asked, you mentioned about the inflation or the growth numbers not sort of sticking to what as per RBI projections. Now let's take the case of inflation. We project a normal monsoon, but then you have sudden, like last year, there are unseasonal, unprecedented rains, and that pushed up the prices of vegetables. Now this is something which RBI, or for that matter, this is something which no one could have, anticipated. So therefore, I mean, you make a projection based on certain available data or based on certain available variables. You make certain assumptions. When going forward, certain totally unexpected, unanticipated developments like sudden rains or sudden floods can happen. Now, with regard to the impact of the monetary policy, and you mentioned that the rate cut, whether we started it a bit early, and whether that it's running out. Now, you talked about the bond yields. Now, the bond yields, it's only in the last couple of weeks that the bond yields have shot up. But all this while, the bond yields were hovering around that 5.77, which is the new 10-year GSEC, or around the 5.79, which was the earlier 10-year GSEC. All these months, the rates, the bond yields were hovering around that 5.8, 5.82, 5.83. So it was close to that. It's only in the last fortnight that they have hardened. The bond yields have hardened. And so it's not correct to say that RBI policy, rate cuts have not worked. And if I can draw attention, your attention and the attention of the other participants who are here, if you recall, my statement which I made on 6th August, the MPC statement which I made on 6th August, I have clearly said how the rate transmission, that is the rate cut transmission, has taken place to various segments of the financial and money markets. Let us take the case of corporate bond markets. In AAA segment, the transmission has been more than the yields. The interest rates have fallen by more than 270 basis points. Even investment grade, the lowest investment grade in BBB minus, also that there has been rate transmission. With regard to fresh loans sanctioned by the banks, the transmission has been about 160 basis points, of which about 90 basis points transmission took place post-March. So therefore, whatever measures the Reserve Bank has taken, whether it is rate cut or whether it is liquidity infusion or other measures, I think they are having their desired impact, and the impact is still playing out. And with regard to the current spike of bond yield, it is something which has happened in the last fortnight. You see, as RBI, our emphasis is to ensure that the financial markets, all segments of the financial market, whether it is the bond market or any other, or the currency market, they function in an efficient and stable manner. That is the responsibility of RBI as a regulator. We are constantly watchful, extremely watchful, and as and when situation warrants, or as and when we anticipate certain emerging situations, we will deal with it.
Thank you, sir. So you are reiterating that all options are open, conventional and unconventional, and even rate cut. So you have changed the way monetary policy, we have seen the monetary policy. I mean, you have made it that 25 bips hike or cut is no more a sacrosanct. It can be something else. You have introduced TLTRO. You have introduced twists. So many new things you have done. So do you think, sir, is the time also to be a little explicit in your forward guidance on policy rates, yield curve, liquidity management, etc.? Because somehow there is a bit of, over the last fortnight, I'm just talking about that, there is sort of there's a disconnect between RBI and markets. I'm not talking on behalf of the markets. I'm not a bond dealer, so I have no stake there. But since you have made so many changes, Do you think you could be more explicit? Like yes, you will continue to have excess liquidity and reverse repo will continue to remain the functional policy rate, so on and so forth. That will be reassurance, I think, for the market. Is that so?
Well, I think it will be always good. The central bank should not become too predictable and should always give surprises to the market. But on a more serious note, I mean, that was that was beside the point. On a more serious note, let me say that we live in a dynamic world. Forward guidance we have been giving. For example, with regard to the policy rates, with regard to the MPC resolutions, if you see, we have given sufficient forward guidance when we announced changeover from neutral into accommodative stance, and we said, and we have even said so in our 6th August MPC also, that the monetary policy stance will continue to be accommodative as long as it is necessary as long as it is necessary for growth, and keeping in mind or rather while checking having the inflation objective and while keeping inflation under control. So we have given forward guidance with regard to our monetary policy. And with regard to the new measures which we have announced, I would just like to say that it's not deliberately we are suppressing or holding back any information. We live in a dynamic world. In a dynamic world, situations arise which no one would have anticipated, which no one would have expected. So when a situation arises, then the central bank has to respond to that situation. So in a dynamic world, it is quite natural that the Reserve Bank will have to come out with new instruments and announce them. Take the case of TLTRO you mentioned. Now, in February first week, in that MPC, we had announced LTRO. Now, we found that LTRO was, the bulk of the LTRO was going into, going to the banks, and it was going into, various other purposes. Then we realized that we would like to make it targeted to the corporate bond markets. So therefore, we announced the TLTRO. It was a targeted LTRO. We announced, LTRO, which was a liquidity infusion measures. We found that banks which had excess SLR, they were able to avail, the benefit under they were able to get additional liquidity under the LTRO. So therefore, on 27th March, we announced a CRR cut by 1%, because CRR cut is agnostic to how much SLR bonds the banks have. So it uniformly, it gives, depending on the size of the bank, every bank got additional liquidity to deploy. So therefore, we are responding to constant situations. We, for example, found that the microfinance segment and small NBFCs were not getting additional liquidity. So therefore, we announced targeted direct liquidity infusion into all India financial institutions like the NABARD, the National Housing Bank, and the SIDBI, and who in turn, gave liquidity and extended the liquidity and credit to smaller MFIs, to smaller NBFCs, and other such small entities. So we live in a dynamic world. New problems arise, new challenges arise, and we keep on responding to that. So it is quite natural that there will be such new measures announced by RBI from time to time.
No, absolutely, there's no complaint. In fact, you are dynamic, you are flexible, and you are very different. So it's all in a positive sense, I'm saying. So you have been continuously saying that your objective is to see through the government borrowing, market borrowing in a non-disruptive way. And we know that it has gone up, and it could go even up. And if we include both the state and central government borrowing, the amount is quite high. So is there any kind of thing you are expecting from the government? Is a sort of a fiscal roadmap? What's your expectation from the government?
No, I think I must say that the government has been very responsible in announcing the various fiscal support measures. If you see, if you see the announcements made by the government, there are two things which stand out. The first set of announcements, which I think government made on 26th March, basically were targeted at the vulnerable sections of the society, the poorer sections of the society, through the PM Garib Kalyan Yojana and the other measures. Very recently, again, the NREGA allocation has been substantially increased, or direct DBT to the mudra, to the this no frill accounts which the banks have, and which the poorer sections of the society they have. So DBT and all these measures, that was mainly to support the disadvantaged sections. Then subsequently, I think in the month of May, in the middle of May, the government announced several other measures. And second, so first point, which government, which has to be noticed, is that the first set of measures was targeted towards the poorer sections of the society, and then the lot of other measures which were announced in May. One critical component of that were a series of reform measures which the government has announced. So I think government has been fiscally very, very responsible. Their response has been very calibrated. Well, I cannot speak for the government. I mean, it's for the government to decide on the fiscal roadmap, and I cannot really speak for the government. But I just want to say that in the central bank, as observers of what is happening in the country in the fiscal policy, I think the government's response has been very prudent and very calibrated. Coming to the bond yields, I was just yesterday at the current the new 10-year bond yield, it went up to about 6.22, 6.22. Then it came down post announcement of the operation twist by RBI. It came down to 6.12. Yesterday it suddenly shot up to 6.19. I was just looking at my screen, and I think at the moment as we are speaking, it is 6.14. So therefore, bond market is impacted by so many other factors. A statement comes from FMOC in the United States, the bond markets in India will obviously react to that. For example, Jerry Powell said that US will not manage bond yields. Now, immediately the markets across the world they reacted. I'm not saying that RBI manages the bond yields. Bond yields is a function of the market, but our responsibility is to ensure that there is orderly, non-disruptive borrowing by the government. And
absolutely fine. So we'll have just two more quick questions. One is this: now you are expecting a new MPC. Now, given a choice, would you like to see, like right now you have three from Reserve Bank of India and three outsiders, but all of them are academic world and economists. Do you think the ideal composition should be person from finance or labor market? That's the kind of thing you think the new composition, if you have a say, would you like to have that? That's one. And instead of targeting headline inflation, should core inflation be the concern of MPC?
No, I think, so far as the composition of the committee is concerned, it's the prerogative of the government to appoint the external members. But yes, having said that, let me also say that the governor is a part of the committee which selects the external members and recommends it to the ACC for approval. So I am a part of the selection search cum selection committee of the government, but it is entirely government's prerogative. And to your point, I would like to say that the aspect of conflict of interest is also something which has to be taken into consideration. It is there in the Act, and it is there in the RBI Act in the sections relating to the MPC. Now, with regard to your other question, where you said with regard to the policy
headline inflation, yeah.
Sorry.
Headline inflation versus core inflation. Because headline, there's a overloaded in terms of food inflation, which is it's completely on which you have you can't control that. So
you see the legal provision. If you see, I think section 45, section 45ZA of the RBI Act, which deals with monetary policy. I think it's very clear. It says that RBI is responsible to maintain price stability, and price stability is defined in terms of maintaining CPI inflation. So the law is very clear, and so therefore, Therefore, there is no point in entering into something which is already cast in, black and white in the act of the parliament passed by the parliament.
Okay, sir, we are running out of time, so I have only one more question and then one observation. It's you are pretty, I would say that, well, you are all praise for the banking system, you said and all, but your annual report spoke about how risk averse are the banks, and you did say that basically they are not doing the job of financial intermediation. So my question to you, sir, I mean, how do you make them shed their risk aversion? Because they are going in a big way into buying bonds and helping the government borrowing program, etc. In the process, if the bond yields continue to rise, they may get hit. They're also scared there on that part of thing and all. So is there any way RBI can, what can RBI do to help the bank or make the bank uh, shed their risk aversion? One could be like, would you like to cut down the risk weightage for certain segments to give to encourage them to give loans? Would you like to raise the HTM category to protect them from the from the way the from the risk of bond yield going up and impact on their portfolio? I'm just curious to know, sir, how would you make them get into lending? And as you say, that is the business of financial intermediary.
Okay, what measures we will take going forward? Obviously, I cannot spell out, and I cannot give out. You will have to wait as and when any decision is taken by the RBI. You will be the first to come to know because we announce it in the media. And with regard to the banks, well, I said that the Indian banking system is sound and safe. Having said that, I have pointed out in my address, the text of which will be uploaded in the RBI website. I have also said that, and let me once again repeat, and I have said it in the financial stability report, in my forward to the financial stability report also. Now, extreme risk aversion can be self-defeating. And I said it in today's address also, that extreme risk aversion would create a situation where the banks will not be able to win their bread. In other words, it will impact their income also. Extreme risk aversion is certainly not desirable. What is desirable, I have said, is that focus on governance, on risk management, on quality of decision making, and going forward, building up resilience. So risk aversion is something which needs to be, dealt with effectively by the banks. The problem of frauds in banks also is something which I have highlighted. And there are several other areas which I have highlighted in my speech, in my address today, which is there in the text. And let me also say that you asked what the Reserve Bank can do. Now, over the last, several months, if you see, we have come out with several regulatory guidelines for banks, for NBFCs, for urban cooperative banks, for the financial sector as a whole. And let me also mention that we are constantly engaged and we are constantly holding consultation with the banks. I would have, after my taking over in the RBI in the last 1.5 years, I would have had at least about 5 to 6 or maybe 7 interactions with the MDs and CEOs of both public and private sector banks. And even during the times of COVID, we have had our interaction. And even before deciding on the resolution framework, we did have an interaction with some of the senior bankers, both serving bankers as well as retired bankers. So we are constantly, RBI as an institution, we are constantly engaged with the banks. And that is why, as the theme of my speech today, I have decided to call it, it is time for banks to look deeply within, reorienting banking post-COVID. Now, I don't want to sort of stand in a high pedestal and start sermonizing to the banks. Of course, as a regulator, we are required to give regulatory guidelines, and we will continue to do that. But let me also say that our approach has been consultative, and we are constantly engaged with the banks as a central bank, and we will do all that is necessary to sort of ensure that the Indian banking system continues to be sound and safe.
Thank you, sir. You are innovative, you are flexible, you are dynamic, and you believe in consultative process, be it markets, be it banking, all participant, all constituents, and that's very reassuring and it's a refreshing change on the Mint Road in Mumbai. Sir, my last thing is a personal question. Did you play cricket in your college or university days, or the IS Mussoorie, wherever your first initiation was there? Used to play cricket, sir?
Yeah, I have played the game of cricket in my school, not so much in
Okay.
college, but I have played the game of cricket in school, and thereafter off and on. I have been playing the game of
Sir,
cricket. And let me also mention that I am an avid follower of the game of cricket, and I do have some knowledge and idea about the nuances of the game of cricket.
sir, you don't have knowledge and ideas. That's I mean, I don't bother about that, but still you are playing cricket. So if I am a bowler, on the media, it's very difficult. Forget getting out. There can't be even one appeal, because the ball which is going outside the off stump, you just leave it like that, like the MPC question, or the balls which are bouncers, etc. You are either pull or hook and goes outside the boundary. So from media, we can't just make even one appeal. How's that? You are continuously playing cricket, and sir, continue to play cricket. I wish we could have extended it by 1 hour or so. But it's amazing to hear you. You are so meticulous and so reassuring for the banking, for all the bankers and all the constituents of banking system to hear the governor in such a difficult time. Thank you, sir. Thank you.
Thank you. Thank you. And namaskar to all the participants. Thank you.